Hey guys, what is going on? Welcome back to my Robinhood portfolio. As always, hope you guys had an awesome day trading. A little bit more difficult to say that over the last week or so. You can see in the middle there, S&P 500 extends losing streak to 8 sessions. This has really been prompted by some hesitation, some uncertainty in the markets regarding the U.S. presidential elections, which will be taking place next week, November 8th, which is on a Tuesday. You can see here my portfolio, again in the red, has not been doing well. Over the last day, I lost $161.65, 0.82% of the market, or my portfolio. The markets, all three major indices were down as well. NASDAQ was down 0.92%, S&P 500 0.44%. The Dow 30 was down almost 29 points, 0.16%. Like I said, my portfolio down 0.82%. And I just wanted to highlight this as well. Over the last week, you can see down almost 4.02%, $815 or so. So I've been losing quite a bit of money. And as I scroll through my portfolio here, you can see a lot of stocks in the red, essentially representing stocks that closed lower today than prior or the previous day. And as I scroll down my stocks here, as you guys remember, all my stocks are essentially segmented with regards to market segment. You can see all market segments here have been essentially affected and have been trending down. Possibly my energy stocks here, XOM, CNP, SO, were spared somewhat here, as well as my financials, BOFI, HBAN, WFC, so we're sort of in the green, but for the most part, the market as an entirety has been trending down. I know a lot of investors have been, kind of nervous over the last week or two, have been cashing out and buying, safer investments like bonds. But I definitely would not be doing that right now. Not only will you be locking in market losses, but I really think the election is depressing the markets right now. After election, I think, especially if Hillary Clinton wins, the markets are going to bounce back quite nicely. Again, that's my opinion. That's a little bit of kind of market timing talk, but I really think that's going to be happening. What I probably wouldn't be doing is buying things like bonds. A lot of investors in kind of shaky markets, when they get nervous, they kind of flock to the safety of bonds, but I wouldn't be doing that right now. For one, actually, let's just quickly review what is a bond. So a bond is basically a loan or IOU. These can be issued by big corporations, companies, cities, or governments, and it's essentially a promise to pay you back your principal as well as a percentage of interest as well. Typically, these aren't high interest rate loans. Junk bonds can be, but they're very high risk. The safe investments that I consider bonds are sort of like U.S. Treasuries, essentially bonds issued by the U.S. government. They're essentially I think the quote is backed by the full faith and credit of the U.S. government. So they're deemed virtually risk-free for the most part. But again, the yields are fairly low on these. Bonds are good because they are safe. They provide good income. Any portfolio, especially if you're nearing retirement, should have a proportion of bonds in them. It really buffers your portfolio against downtrends like this over the last week. These downtrends would be buffered by the allocation in bonds, but bonds have very low interest rates, and the other thing, the big thing too, is they have an interest rate risk, and as I talked about, right now we have historically low interest rate issued by the Fed, so the rates have nowhere to go but up. So what does that mean? Well, essentially bonds and interest rate have an inverse correlation. So any changes in the interest rate will essentially reduce the market value of the bonds you hold, the current bonds you hold. And that is due because when a bond is essentially generated or issued, it's really issued at an interest rate that is in that current time frame. So for example, right now if a bond is issued, it's got a very low interest rate because we're at historically low interest rates. In a few months, a few years, when the interest rates go up, those bonds will have a much higher interest rate. So as you can imagine, if a bond has a long maturity date, let's say 20 years, it's originated today at 1%, in a few years when bonds may be originating at 5%, nobody's going to want that 1% bond. And a lot of investors may even sell those bonds at a loss so they can lock in their capital in much higher interest returning bonds. So I kind of hope that makes sense. I went over that pretty quickly. But essentially, if you think interest rates are going up, bonds are a terrible decision. And we can take a look at a couple bonds here just to kind of give you an idea. Unfortunately, in Robinhood, you can't outright buy bonds, but you can buy bond ETF. So again, here's a Treasury Bond, essentially debt issued by the U.S. government. You can see here, you could argue possibly that it's been holding steady, hasn't been losing money over the last week and month like my portfolio has been losing. But if you look at, the 5-year and 1-year performance numbers here, you can see 1 year 0.99%, 5 years 2.74%. Well, over those time frames, like for example the 5-year time frame, the S&P 500, if you had just S&P 500 stocks, went up 150%. So buying this bond would be essentially kind of silly. I know it's safer investment and virtually a guaranteed investment, but to me it's kind of silly. I mean, you have no return there. This particular ETF as well, over the last 1 month and 1 week, it's been relatively stable. But again, over the last 1 year, 5.46%. Over the last 5 years, 16.17%. So you really haven't had any appreciation. I know a lot of you may say that, well, you're getting some monthly income from this or quarterly income. I'm not exactly sure how these pay out, but again, it's very low. That last one, I didn't scroll down, but it had like 0.7% dividend yield. This one has 1.67% dividend yield. So even if you factor that into the overall return, it's pretty abysmal, to be quite honest. So for those reasons, I would not be jumping out of the market right now and getting into things like bonds. Cash at this point, I think, you could argue maybe jumping out now would be okay, especially if the markets continue to trend down this week. Wouldn't be opposed to that, but I wouldn't be jumping into things like bonds at this point. So, yeah, tell me what you guys think of all of that. That's kind of what I'm thinking. Again, I'm going to hold through. Since I've got this far, I'm just going to go ahead and hold through the election cycle, the interest rate hike, and then get some money on the sidelines saved up to jump into stocks when I think prices are a little bit cheaper here. So yeah, what do you guys think? What's going on with your portfolios? Are you guys holding? Is anybody selling off and buying safer investments? Is anybody actively buying right now? I'm going to be waiting until I put some more money into the market, but you could argue stocks are much cheaper than they were just a few weeks ago. It might be a good time to jump in and get some value with your money here. Dollar cost average a bit here, but not too sure. So yeah, just kind of wanted to talk about my portfolio and this idea of jumping into bonds when the market is kind of in a downturn. So as always, if you like my videos, feel free to like, share, subscribe if you're not a subscriber. I'm all about learning, getting discussions going that will help not only myself but other new investors learn about the market. So if there's anything I said during this video that's not entirely correct, let me know. Again, I'm a new investor. I'm learning. Any insights, any things that I should be focusing on that I'm not focusing on, and you can point out, greatly appreciated. So just leave me a few comments if you have any ideas. So again, just want to talk about my portfolio, about investing when the market's downturning like this. And until next video, we'll see you then.